Welcome everyone to the webinar hosted by the Henry Toll Fellowship Leadership Program. We are going to be discussing tax policy reform in the state today. Real quick before I turn this over to our excellent panel of speakers, we're going to go over a few of the quick housekeeping rules. The webinar is going to begin with a panel discussion and some comments from each of our panelists on tax policy and what they've been working on in their states, and then a brief discussion between the panelists, and then we'll wrap up with a 15-minute or so segment where the audience can submit questions. We got a few questions from registrants as they were registering, and we'll get to those at the end of the presentation as well. During the presentation, if you have any questions that you'd like to submit, feel free to do that in the chat box section of your GoToWebinar dialog box. All the attendees will be muted to cut down on background noise, so you won't be able to ask any questions over the phone line. So you will need to submit those through the chat section of the GoToMeeting box. And then if you have any technical difficulties, real quick, write down this email and or phone number, and one of our staffers can help you out. You can go to registration@csg.org or call 800-800-1910, and someone can help you with any technical problems that you have. And a quick note that we are going to record this, and it will be posted on the CSG website shortly after the conclusion of this here in a couple of days, so that you can either come back and revisit it or share it with colleagues that you think might find it of use. So at this point, Representative Lane, I'm going to go ahead and turn the floor over to you to get things started.
Thank you very much, Krista, and thanks to all the folks who are joining us, and also to the Toll Fellows Program for hosting this. We really think this can be an hour of intelligent conversation about very complex issues that are seriously affecting almost all states in the nation right now. Having been a member of the Appropriations and Revenue Committee in Kentucky for nearly 20 years, tax reform has been something that has been on my radar screen, in the very center of the screen, in fact. And for the past 12 years, we've proposed tax reform packages that would comprehensively reform the revenue system in Kentucky. The states that are facing serious fiscal problems right now due to the recession also have to face the fact that there are other issues involved in just the downturn in the economy that are affecting the decline in revenues in our states. And among those things, I think we have to say is the tax policies in many states are oftentimes unfair. They affect the working class, the middle class, or the lower class much more heavily than the wealthiest. Often, as we see right now, in times of downturn, they're inadequate. They're sometimes too complex. And most importantly, in times like this, they're not buoyant. They're not addressing the growing areas of the economy and the declining areas of the economy appropriately. So it ends up, we end up in real tight fiscal situations the way most states are stewing in right now. The three components that I think we want to address today, among others, would be reform of the tax policies. And much of this has to do with the expansion of the services in our economy as compared to the emphasis on purchasing merchandise of, say, 50 or 60 years ago. Also, the issue of the growth in the e-commerce transactions, and a major issue that all states have to face if they have a sales tax is the many sales tax exemptions that have oftentimes been incoherently adopted into their revenue statutes. So to discuss these and many other topics, we have two really great professionals. Michael Kosta is going to begin his presentation here in a minute, but before he does so, I'd like to just tell you that he is on the, or has been on the Vermont Blue Ribbon Commission to discuss, or to study the revenue system in Vermont. And that system, I think there's some slides on your screen that he will go over, but that commission that reviewed the entire system of Vermont and did a very comprehensive study and list of recommendations. So Michael, we welcome you, and also shortly I'll be introducing Missy Fulton, who is the Assistant Commissioner in New Hampshire for the Department of Revenue. But let's start with Michael. Michael, you want to begin your presentation?
Yes, thank you very much, Representative Wayne. Thank you to the Toll Fellow Program and everybody who's on the webinar today. Vermont impaneled the Blue Ribbon Tax Structure Commission in 2009. It was a three-person commission appointed by the governor, the Speaker of the House, and the President Pro Tem with an open-ended task to study the tax structure and make recommendations for a more simple, sustainable, and fair tax code in the 21st century. After a year and a half of effort, the Tax Structure Commission offered a report to the legislature and the public that really focused on offering two things. One was findings, which was really an education piece, which is much of what, and I'm sure everybody here who does tax policy would agree, much of how the folks in Vermont talk about the tax code turns out to be incorrect or otherwise unhelpful to the public dialogue on taxes. So the Commission tried to offer 6 findings that challenge conventional wisdom and form the basis of the Commission's recommendations and sub-recommendations. And in a way, what the Commission was trying to do was to really reset the public dialogue on taxes and make the Commission's report the touchstone for future tax discussion. And I think it's fair to say that they accomplished their goal as a Commission in that regard. The more difficult challenge was making policy recommendations. The Commission recommended sweeping changes to Vermont's personal income tax, sales tax, tax expenditures, and also some additional tax resources. The Commission's task was to be revenue neutral, which means we weren't out looking for more money. However, the Commission took a hard look at the things that Representative Wayne mentioned a moment ago. Reforming tax policy, this issue of the growth of services or the sales of goods and what that's doing through revenue systems, growth of e-commerce, and then the shadow budget that is tax exemptions. For example, Vermont collects $1.8 billion annually. We're a very small state, but we have $1.2 billion worth of tax expenditures, and this is a serious problem. So going on to the next slide, I just wanted to give everyone a brief overview of what those 6 findings were and how this informed tax policy discourse in Vermont. The conventional wisdom, something the Commission heard over and over again, was that everyone needs to pay their fair share. What the Commission found was that this argument focuses entirely on the personal income tax and ignores other tax types and rising income inequality. Vermont is known nationwide as a high income tax rate state. I think if you search the archives of the Wall Street Journal, it's very difficult to find a reference to Vermont that doesn't say Vermont, a well-known high tax state. And what the Commission, one of their findings was that sure, Vermont has some high income tax rates, but there are policy choices that Vermont makes that drive those rates higher unnecessarily. The major one being the fact that Vermont has a taxable income tax base. So we're incorporating all the tax expenditures, all the pass-throughs in the federal code along with our own exemptions. And so there's this rather large gap between marginal and effective rates. And that if you could narrow that spread, you could have a more transparent and simple tax system with lower, more competitive rates, and then also have more capacity to raise revenue in the future if that's something the legislature wants to do. The sales tax base is uncompetitive due to the New Hampshire border. I think it's hard to overstate being in Vermont next to New Hampshire, which lacks the general income tax or sales tax, how often New Hampshire is referenced compared to Vermont's tax system. I mean, much of the discussion about Vermont's tax system typically features a noun, a verb in New Hampshire. But what the Commission the point they tried to make to the public and the legislature was that, well, New Hampshire's lack of sales tax is a concern, that consumer purchasing patterns, particularly the switch to services and internet and remote catalog sales, are eroding the tax base statewide in a way that's much more severe than tax competition from New Hampshire. I think everybody here is probably aware that the last time that goods and services consumer spending was equal was 1967. Currently, about 2/3 of consumer spending focuses on services, only 1/3 focuses on goods, and then the internet and catalog sales are an additional drag on that. If you could put up the next slide, please. Forget taxes, I want to talk about government spending. The Commission did not get into government spending, but many times tax reform efforts are plagued by a focus on government spending when that's not really the point of the tax system. However, the Commission moved great lengths to describe the tax expenditures as a shadow budget, with spending worth more than $1 billion, which in Vermont is still a significant number. And what the Commission really came out and said regarding tax expenditures is that we do these policy choices in the tax code, we spend all this money, but we really don't measure it. We really don't find out if it works, if there's any return on investment. And so the Commission spent a lot of time talking about ways in which we could figure out whether these policy choices actually achieve the goals that they presumably are set out to do. Taxes are driving wealthy Vermonters out. Tax flight is a big topic of discussion here, and it serves as a brake on any proposal to raise the personal income tax. So, much like many other states, Vermont's been dealing with a persistent budget deficit over the last few years. There are folks that want to raise the income tax, and the idea of tax flight is the #1 thing that acts as a drag on that proposal, and has so far successfully stopped any effort to raise income tax rates or put on a surcharge. What we found, though, when you actually look at the data, federal IRS data, more income moves into Vermont every year than is leaving, but the people moving in make about 20% more than the people moving out. And then Vermont, actually, when we talk about high-income Vermonters, there's an open question about who you're actually talking about. It's more accurate in Vermont to consider high-income events than earners. And really, if you really get down to it, the high number of high earners in Vermont, as we'll talk about in a second, number in the few hundred. And then the property tax is too complicated. This is really a local issue. Vermont has a statewide education property tax that is very complex and has been an issue of contention politically for the last 20 years, but isn't particularly relevant outside of Vermont during this webinar. The next slide, please. So I just wanted to run you through an example of what the Commission meant about findings and some of the arguments that the Commission made to the legislature. Do all Vermonters pay their fair share? And the answer the Commission had was yes. Most people say that all Vermonters need to pay their fair share because many people pay the income tax, and there are many people that don't. But what this is based on is that 60% of Vermonters' income tax is paid by only the top 11% of earners, and this type of argument acts on a drag on revenue generation with income tax rates. But the Commission pushed back with arguments that this ignores rising income inequality, and it ignores the total tax contribution of each taxpayer. Next slide, please. And one of the things that we pointed out to folks in Vermont, to the legislature and the public, is that people, when they talk about taxes, they want to talk about the income tax, but that's only one of, as everyone knows here, the 3 major tax types. And so what we did was we worked with ITEP to put together data that charted by income class the percentage of an individual's income spent on each of the major tax types. And it charts out the way you would think in a progressive tax system, of which Vermont's personal income tax is highly progressive. People at the bottom end of the income scale pay very little in income taxes. People at the top pay a relatively higher proportion of their income, percentage of their income in taxes. But sales taxes are regressive, and property taxes are somewhat less regressive than sales taxes, but still regressive. But overall, people by income class pay a relatively stable amount of their income in taxes. This is in contrast to New Hampshire. There are a lot of folks here that say that we ought to have a tax system that's more like New Hampshire without a sales or income tax. And if you look at the next slide, that policy choice has pretty significant impact. New Hampshire without a general income tax or a general sales tax, though it does have some sales tax-like levies, has a generally regressive tax system, which so far Vermont has been unwilling to move to, though it was a big point of debate during the last gubernatorial election. On to the next slide. Something that in the grand sort of tradition of tax reform and raising revenue, the real call in Vermont was to broaden the base and lower rates. Vermont has some mechanisms to do that because Vermont has a taxable income base instead of an AGI base, and then is rather permissive with both federal and state level deductions. So we have this headline rate of 8.95%, which is of course the highest in New England and among the highest in America, which really really lends itself to arguments about tax capacity and the personal income tax, that really there's nowhere to go. However, you're not measuring apples to apples because our tax base is so dissimilar from the other states around here, and so dissimilar from most states nationally. So if you go on to the next slide, what we have here is the effective rate. So we have this dialogue about taxes and about whether you should raise or lower taxes, or whether during this time of sort of budgetary turbulence you should raise more revenue. And you have a good deal of the political discourse saying, well, we can't raise income taxes because the top tax rate is nearly 9%. Well, given the fact that Vermont's tax base includes so many deductions, it creates this distortion where people feel like they're paying 9%. But on average, as you can see on the chart here, over the last 30 years or so, the average effective rate is only 3%. So this is really quite a spread. So then the next logical question is shown in the next slide, which is, okay, so on average everyone's paying 3%, but with Vermont's heavily progressive tax code, what do people at the top pay and what do people at the bottom pay? And this chart here shows the average effective rate in 2008. And it certainly shows that the system is progressive, but what it also shows is that even at the top of the income scale, say Vermonters with an income over $1 million in 2008, the effective rate of about 5% is nowhere near the top marginal rate of 9%. And so this was in no means an endorsement by the Commission that income taxes should be raised or more money should be raised off it because their task was to be revenue neutral. It's merely saying that if you're going to have this discussion about tax capacity and competitiveness and revenue, you should really acknowledge what people are actually paying and the kind of policy choices in your tax base that go into that decision. And one of the interesting things is there are plenty of people in Vermont who would suggest going to, say, Massachusetts' 5.3% flat tax. But if you ran a red line down here at 5.3%, you can see almost everyone would pay more on average in the income class with a 5.3% flat tax, even though it appears to be more competitive. Next slide, please. One of the big things with revenue, like I said before, any sort of tax claim in the personal income tax lends itself to the idea that if you raise income taxes or do anything with the income tax, you're going to encourage tax flight, whether it be to New Hampshire or some other jurisdiction that doesn't levy an income tax. Same with sale of goods and services. The Commission discussed whether some of the tax expenditures for sales should be removed and whether the sales tax should be extended completely to services. And since New Hampshire doesn't levy a consumption tax for the most part, the argument immediately is businesses will flee to New Hampshire or some other jurisdiction if you raise taxes. So one of the ways in which the Commission went about trying to talk about this was to take a look at the data we have to see if it supports claims of tax flight. And so what we found with IRS data was that people moving into Vermont, on average, move 18%, earn 18% more money than filers moving out. And that's been fairly consistent over the last 20 years. And then we put together a panel data that demonstrates Vermont's high-income population is defined by events rather than annual income, and then ask the question, should you design a tax code around 200 filers? If you go to the next slide, what you see here is we did a panel study over 9 years and captured all the folks who had an income, an AGI of $500,000 or higher during the course of the panel study, which was 2000 to 2008, and then measured how many years they earned $500,000 or above. And what you see on the chart here is that the majority of them, 52%, earned over $500,000 in AGI in one of those 9 years, and then not again. 16% had it in 2 years, or 10% had it in 3 years. But it was a very small group of people, 3%, about 200 tax filers that had over $500,000 of income all 9 years. And so the point the Commission was making is that, the folks that, when we talk about what wealthy folks are doing in Vermont and whether they're fleeing Vermont, you really need to be careful about who you're actually talking about, because there are far fewer people in that class than even sort of the tax statistics that we generally publish indicate. That it's much more likely that folks in that top AGI, in Vermont at least, are having a high-income event. They're selling a business, they're selling a home, they're cashing out stocks at retirement. And so when you talk about making policy decisions based on the idea of tax flight, you really should bear down and make sure you're using the best data and not twisting yourself up into knots about something where the data is less conclusive than most anecdotes. Next slide, please. So the recommendations, the Commission, and I'm sorry to give you the very short and fast version of this, but the Commission recommended restructuring the personal income tax. They recommended shifting the tax base from federal taxable income to adjusted gross income, which would increase the tax base in Vermont from about $10 billion to $15 billion annually on the personal income tax, eliminating all standard and itemized deductions, implementing a lower, flatter bracket structure, basically 3 brackets, with the top one stopping at $150,000 and a top marginal rate of 6.95%, and then implementing a residential credit as a transparent alternative to deductions. What the Commission was really trying to do here was to make the logic of the tax code more explicit by taking out most of the deductions, really all the deductions actually, and narrowing that gap between marginal and effective rates. They felt that you'd have a more honest tax code, and that credits treated all Vermonters who qualified for them the same. I think it's worth noting that the Commission strived for and was able to achieve a distribution that is similar to the one we have now. So it's essentially people would be paying on average around the same. However, it would be a more transparent and easily understood and explained tax code. Next slide, please. The sales tax base, and these recommendations were very controversial. The Commission recommended levying the sales tax on all consumer purchased services with limited exceptions for certain health and education services and business-to-business transactions, and eliminating all consumer-based sales tax expenditures with the exception of food and prescription drugs. It's interesting. I mean, the Commission conceptually was at the point for almost its entire existence that they should levy the sales tax on all goods and all services and reduce that sales tax rate from 6% to 2 to 3%. One of the commissioners decided near the end of the process that he couldn't support that, and then as that happened and they didn't have a unanimous recommendation, the other commissioners started peeling off individual exemptions, for example, with food and prescription drugs. And it's probably a useful lesson for bringing this to the legislature. Either everyone's in this together to really broaden the base and lower the rate and be able to reestablish and make healthy your sales tax base, or as soon as one person or one thing gets peeled off, it is very hard to hold folks together. Next slide, please. And reform tax expenditures. The Commission recommended that a legislative intent be adopted for each tax expenditure. And what that means is, for example, we have a tax expenditure for residential heating fuels. You don't tax oil or propane here in Vermont. But we don't know exactly why we do that. We presume we do it to help low-income folks with their heating fuel. However, every single Vermonter gets that. No matter how much money you make or how little money you make or how big your house is or how small your house is. The Commission made a recommendation to refine the capacity to evaluate return on investment so you could actually know whether these things do what they say they do. And then to sunset all tax expenditures in a multi-year cycle. So the legislature actually has to evaluate and affirm these policy choices to make them much more like the state budget. Vermont, like a lot of states, has tax expenditures that once they get on the books are very hard to remove. Until recently, there was a tax expenditure that applied to veterans of the Spanish-American War, even though no one had qualified for that exemption in 30 or 40 years. And it just demonstrates the difficulty of getting rid of these policy choices. And as Representative Wayne said, these are, you can see this with the coming battle at the federal level about tax expenditures. There is serious erosion of the tax base, and they force rates up, and they're a shadow budget, and they ought to be addressed. The next slide, please. And the results, I will say that the Commission's report has become the touchstone for the tax debate in Vermont. It really framed the tax discussion for the 2011 cycle, and it looks likely that it will again frame the debate, particularly for the legislative money committees in the 2012 session. All the recommendations of the committee were put forth by the Commission, were put forth by the Ways and Means Committee in a bill. But really, during the course of the session, the only piece of the Commission's work that got serious attention was the income tax reform, and then to a lesser extent, the tax expenditure language. The sales tax items, particularly sharing a border with New Hampshire, just became too controversial, particularly since the new governor came out and opposed it almost immediately. The income tax reform, the money committees spent a lot of time on them, but they were unable to come to agreement. And the primary obstacle was that if you're going to make the rates more competitive, there are going to be some people in upper income brackets who pay less in taxes. And the legislature seemed to have difficulty in accepting that. At the same time, they were cutting $160 million, mostly out of social services. So there's a feeling here that the legislature understands and appreciates the Commission's plan, especially regarding income taxes, and that it may be the right plan going forward. However, it just may not be the right time. All right. And
thank you very much. Did you want to add something, Michael?
No, I think that's my last slide, and thank you very much.
Yeah, well, for those maybe just tuning in, that was Michael Kosta. He's the director of the Vermont Blue Ribbon Tax Commission, and we really appreciate that comprehensive and succinct presentation.
I was going to say, I hope comprehensive is not a synonym for long. So.
No, it's not. It was succinct.
Thank you.
Thank you, Michael. Our next panelist is Assistant Commissioner Missy Fulton. Commissioner Fulton is with the Department of Revenue of the state of New Hampshire, and she was a 2010 Toll Fellow. So we're really pleased to have her with us, because what Michael is saying is information that many states can relate to, because they have a broad tax system in Vermont, as many states do. However, New Hampshire is much different, and Missy, maybe you can fill us in on what's happening in New Hampshire.
Absolutely, I'd love to. Thanks very much, Representative. Good afternoon, everyone. I am Missy Fulton, the Assistant Commissioner for the State of New Hampshire Department of Revenue Administration. I'd first like to thank all of you for participating in this event today, and I'd like to thank very much the Council for State Governments. I think this is a great opportunity to share information between leaders to make better ideas and better policy reform. I'd just like to start off the program by saying that I started with the department when economic times were good for businesses. Revenue forecasting was done based on percentage growth rates and inflationary rates. And it wasn't until the fall of 2008 did New Hampshire actually see a financial freefall in its corporate estimates, and we experienced statewide financial implications as a result of that declining economy. Before you start talking about the unique nature of tax policy in New Hampshire, you really need to understand a little bit of the political history briefly. We have a very interesting form of government in our state, and it's talked about anecdotally, but it really does affect policy reform and initiatives. Our governor and council form of government finds its roots in 1679 through a commission issued by King Charles II. And the president, who is now known as the governor, and the council's first duty was to create the legislature, actually to raise taxes and to vote public conduct laws. Our New Hampshire's Executive Council holds the distinction of being the first and the last of its kind in the nation. So our governor sits with a Executive Council group of 5, and they share some of the same executive authorities. While the council cannot act independently of the governor, it has the constitutional authority to negate gubernatorial actions. Interestingly enough, the uniqueness is supplemented by having the 3rd largest legislative body in the English-speaking world. It's rivaled only by the U.S. House of Representatives and British Parliament. With 424 legislators, it provides for very interesting legislative initiatives and ways of doing business. But it works for us. It works because everyone has a voice. Next slide, please. There's 10 principles of sound tax policy, and these seem very basic, but we should all keep these guiding principles in mind when you're talking about any reform to tax policy initiatives. The first is transparency is a must, particularly when you're talking about tax credits and special exemptions. Who are they affecting? Who are they going to affect? And how is the state going to make a reasoned analysis as to whether those are actually working? Number 2 is be neutral with the tax policy. Number 3, maintain a broad base. Tax initiatives that provide for tax advantages, for one, are unconstitutional in our state, but they also create a huge loophole that may not be contemplated, which erodes the tax base further. Number 4 is keep it simple. If the taxpayers can't understand the law, then they don't know when to pay it, and the administrative burden on the state side adds to the cost and lowers your actual revenue received. Number 5 is stability matters. Can the tax law last? Number 6, no retroactivity. Problems are caused by refunds. When you have a retroactive law, it skews your revenue estimates. And cases that are actually sitting in court have to be remanded back for new determinations, which can be a huge cost burden for the taxpayer as well as the state. It also skews your historical revenue analysis and increases the cost to the state to change its systems and information backwards in time. Number 7 is keep the tax burdens low. Number 8, don't inhibit trade. Number 9, ensure an open process. does that tax policy do what it was really intended to do? And number 10, state and local taxes really do matter, and they matter to everyone. Next slide, please. The New Hampshire Department of Revenue oversees 14 taxes. We bring in about $1.4 billion a year. We manually touch that money, and we oversee the statewide property tax system, which brings in another $3.5 billion in revenue to the state. This chart will show you the share of the unrestricted revenues that are flowing through the state. From New Hampshire's Department of Revenue standpoint, business taxes combined between the business profits tax and the business enterprise tax account for much of the state's revenue, which is about 23%. And then you've got approximately 27% for various sales and excise taxes. One of our main problems, though, is there is no required business registration process. So we are really unsure as to which businesses are doing business in our state. Next slide, please. As I'll go through this slide, and you'll see, our biggest issue is who should be filing. This is a breakdown of the business entities as we know them to be that are operating in New Hampshire. The far left column shows the Secretary of State's numbers of the various types of entities that have filed with them, which total about 156,000 entities. 57,000 of them are trade names, so presumably those could not really be businesses. They're people just looking to hold a name in case they plan on doing business at a later time. The second column is the total tax filers for tax year 2008 that were filed with the Department of Revenue. And you'll see we received in 69,363 filings. The next column is the New Hampshire-based entities. And just the New Hampshire-based businesses filing were 34,545. The next column entitled DES is our New Hampshire Employment Security Office, and they have about 43,000 businesses registered with them. The column to the right of that is the U.S. Small Business Association, has us registered as having about 108,000 entities. So if you're looking at just between Employment Security and the Small Business Association, there's about 151,000 businesses doing business in this state. But there's a discrepancy across the board of all of the numbers. Next slide, please. To break it down a little bit differently, in tax year 2008, which we're always working a year behind, so this is for 2009. This is the most recent closed year. 2010 is not a closed year yet, so this is the most accurate set of numbers that we have. If you use a conservative estimate of 130,000 business entities operating in the state, 60,000 business entities do not file any business tax returns with the Department of Revenue. 17,500 of the tax returns that we got for tax year 2008 were from entities operating in New Hampshire, but they filed paying zero, presumably to preserve the statute of limitations against audits and appeals. And then we had another 77,500, which would be 60% of business entities operating in New Hampshire, paid neither business profits tax nor our business enterprise tax. Now, our business profits tax is at 8.5%, and then our business enterprise tax, which is a tax on the enterprise value base of a business, is 0.75, which is 0.75%. The BET actually acts as a dollar-for-dollar credit against business profits tax. Next slide, please. So how do we stack up tax burden-wise? If you look at us, New Hampshire has an 8.5% corporate income tax rate, but remember we do have a dollar-for-dollar credit against the business profits tax from payments of our business enterprise tax. When you see a lot of the industry association outlooks that come out and information regarding our state and its tax burden, sometimes that information is skewed because that dollar-for-dollar credit is really not taken into consideration. 8 other states with a flat rate are higher than New Hampshire. You've got California, Delaware, Illinois, Minnesota, New Jersey, Pennsylvania, Rhode Island, and District of Columbia. 2 other states have the same flat rate equal to New Hampshire, which are Indiana and West Virginia. 4 states with variable rates have a high-end bracket equal to or above New Hampshire, which are Alaska, Iowa, Maine, and Vermont. Actually, the Tax Foundation just put out their report for 2011 entitled The 2011 Facts and Figures, How Does Your State Compare ranked New Hampshire in the top 6 for the lowest tax burden in the nation. Next slide, please. This slide is a breakdown of the estimated burden of our major taxes for a hypothetical family of 3. This was put together by the tax rates and tax burdens in the District of Columbia, which does a nationwide comparison of the major cities across the country. And this breaks us out for the New England region. The New England state comparison shows that New Hampshire continues to strive to keep the tax burden as low as possible, with Manchester being the largest city in New Hampshire, having still a low property tax rate as compared to many of the other major cities in the New England region. Our legislature and our governor want to be focused on providing the best services to its constituents at the least cost. However, government spending has taken the overarching scrutiny over the past biennium. Most business-friendly attitudes are the legislative echo these days. And with that in mind, the New Hampshire Department of Revenue has taken the approach to have everyone pay their fair share. In order to do that, we need to broaden the base. Next slide, please. One of the ways we've done that is in the area of e-commerce. What is New Hampshire doing to capture potential tax revenue in that area? Well, the laws of 2007 broadened the definition of business activity under RSA 77A. And we included you'll see it in bold, that business activity now includes a substantial economic presence evidenced by a purposeful direction of business toward the state examined in light of the frequency, quantity, and systematic nature of a business organization's economic contacts with the state. What this really does is it gives us economic nexus. This change has been a tremendous help in asserting what we know as economic nexus, which is not having to have a physical presence in a state, which includes e-commerce. Prior to this clarification, we really had a difficult time persuading taxpayers that Nexus was not limited to those only instances where the taxpayers had that physical presence. We've successfully brought on board some online sales companies as continuing New Hampshire BPT filers. And if you include credit card companies as e-commerce companies, we've brought them on board too. So we have successfully broadened that base in both of those arenas. Next slide, please. One of New Hampshire's other exciting initiatives is to create a statewide GIS system. A geographic information system connects database information to spatial elements. And I'm going to go through several initiatives of how's the state going to be using it, how can a revenue agency actually use this tool, and what is one of our tax audit initiatives that is currently going on. Next slide. So as I said, a GIS system connects the database information to spatial elements. What we've done is we have successfully created a mosaic parcel map of all of the pieces of property in the entire state of New Hampshire. We've been able to provide electronic access and electronic capability to municipalities that never would have been able to be involved in this initiative because they would never have been able to afford it. They're still working from plot plans and from old layouts, and then they will never have the financial resources to convert their data into a CAMA data or into an electronically readable data. So we've been successfully able to marry up all of that data to give every single municipality in the state the opportunity to look at what do they have for property, what is the actual value of the property in that town, and to be able to accurately assess all of the property that's in that area for purposes of property taxation. We're also the only state agency in the state that gets dual pieces of information from both the registry in connection with real estate transactions, as well as information directly from the buyer and seller regarding that type of transaction. What we've been able to do is marry up that information so that we're able to provide real-time access to the municipalities so that they can see when and where properties are being transferred and where there are real estate transfer tax discrepancies. We've done this through the partnership of the University of New Hampshire Technology Transfer Center, and we are proud to say that we have created and implemented the first sustainable statewide GIS system in North America. we'll be able to provide this e-capability in a very short time period deployed to all of the municipalities. Once fully deployed, we'll be able to develop a new property tax equalization system which will streamline and update all of our existing processes to ensure that all of the properties are fairly and equitably administered through the property tax. One of the other really cool things that we'll be able to do with it is we'll be able to step in line first for FEMA money in the event that there is any problem with any statewide disaster. What we can do with this system is it's completely interactive. We can go in and we can draw a polygon around any affected area, and we can value the property for a damage assessment to step in line for FEMA money on a quicker basis. Several years ago, we had a tornado rip through the state. It took my entire division of property appraisers over 2 weeks of man time in the field to figure out all of that damage assessment. We replicated that incident here most recently. We were able to get an entire property valuation and damage assessment within less than 10 minutes, which will be huge for the state for planning purposes and emergency management resources. The other neat area that we're using this GIS tool in is through vacation rentals, through an audit initiative. We have a meals and rentals tax license requirement for taxation to be collected and paid for the rental of vacation homes. We've calculated that there are at least 10,000 to 15,000 homes that are being rented in the state of New Hampshire on a yearly basis that are not collecting and remitting meals and rentals tax. So the tax must be collected and remitted on that rental charge for that vacation home. What the GIS system allows us to do is, again, to draw a polygon around specific types of properties. We can draw a polygon around lake properties, around waterfront properties, around properties next to ski mountains, and we can query who owns the properties, whether they're based on out-of-state addresses, whether they're owned by businesses, corporations, and being utilized for commercial activity. To date, basically one auditor has brought in almost $2 million from this vacation rental project over the course of a year and a half. But the better part is we've been able to get on board over 500 new meals and rentals licensed operators who are continuing to collect that and become compliant in that collections arena. Next slide, please. As I had said before, we completely manually touch all of the information that comes through us. I've entitled this slide, How Do We Solve for X? One of our biggest problems is that we are data rich and absolutely information poor. From a tax reform standpoint, we're unable to give out information on a detailed and consistent basis because everything is processed manually. In fiscal year 2010, we manually processed over 6,000 documents because 78% of our filings still come in on paper. It also almost doubles the cost to the state for these processing costs due to the manual nature of our process. If you see this slide, we actually get flat forms in, which are not intelligent at all. They come through the mail. They are hand processed, hand opened. Checks literally get picked up in an armored car and get sent to the bank on a daily basis. And there is no interaction between the taxpayer and their information within our information management systems. Data is entered into our mainframe and sometimes can take upwards of 9 months to get in there and fully fleshed out. The other big problem is that we do not capture all of the information that's contained within those forms. So when we're asked to do revenue analysis as to the fiscal impact of certain legislative initiatives, we're unable to provide that information because we don't have it in a readily available format. The added problem is that the information is entered into our mainframe, as you see in the middle there, our tax information management system, but because of the legacy system, every time a new tax or an enhancement has come on board, simply a PC application has been created. So there are multiple silos not talking to each other with multiple pieces of information. Although the legacy application has been enhanced over the last 20 years, it is very labor intensive to get information out of there. We started searching after the fall of 2008 free fall to figure out how could we get a new tax information management system in, but the cost was prohibitive. Some of the states were spending upwards of $25 to $40 million for software licenses, consulting services, and the hardware, and we simply didn't have that kind of a money to get from the capital appropriation. Our research told us that a lot of the expense of these projects was devoted to the data architecture, either figuring out how to access disparate information and put it into a usable format, or how to migrate that data to a new computing platform altogether. So what we've been able to do is, through a much smaller capital appropriation, is to be able to build a platform on top of all of our good, rich data that we have and provide for a more information-rich system. Next slide, please. Access to the disparate data sources will provide us with enhanced safeguarding and better use of our federal taxpayer information that we get in from the IRS. It's going to provide for us the ability to dissect and do statistical analyses that we currently are unable to do, because right now much of the analysis has to be done by hand. We actually have to hand pull tax returns in order to be able to provide valuable information to the legislature so that they can make policy reform initiative information, but be fully informed as to when they're doing that. And one of the biggest things that we're doing is providing for a single view of the taxpayer. Right now, because of all of our siloed systems, we can't see a single view of the taxpayer. So it is costly for us to send a collector out to one day collect on one piece of tax, and then just have them go out and collect it another day for another tax notice, and so on and so forth. The single view of the taxpayer will allow us the opportunity to look at the interrelationships between taxpayers on an individual basis as well as on a business basis. This will provide for the backdooring in of not having a business registration process, as I had discussed before. Next slide, please. Okay, this slide looks blank, so we'll go to the next slide. Oh, here it comes. Thank you. This is just a slide illustrating the flow of the data from the disparate sources that we're putting into an enhanced platform. What we've been able to do is just lay a platform on top of our AS400 I-Series computer system at a much cheaper price, provide for a statistical package, and provide for workflow management, which will help us determine the cost of performance and how much does it really cost to do business. We'll be able to marry up the GIS data system that I had discussed earlier with all of our other sources of information so that we can provide better statistical analysis and much better modernization efforts for the taxpayers. Next slide. I know this slide is busy, but this is exactly what we're working on. The department is going through an evolutionary process change right now, and we are completely modernizing from floor to floor to floor on the most efficient and the cheapest way possible to be able to successfully run our business and run our systems in a better enhanced customer service experience for taxpayers, make it easier for them to pay and increase the revenues. You'll see we'll be able to provide for e-filing as well as paper filing. What we are doing here is we're creating ourselves to become the document processing center for the entire state, should that be the want of the general court. We're providing for document scanning and imaging of all of the information when it comes in the door, which will provide us for greater audit opportunities and much more reasonable approach when you're dealing with taxpayers, because you're not knocking on their door 3 years later looking for some records or information. You'll be able to get a hold of them within a couple of weeks, and you'll have all of the information from all of the forms so that you'll be able to do better statistical analysis. We'll also be able to provide for taxpayers to have a view of their tax history and to be able to do basic updates of their own tax information, which will provide for that customer service effort. You'll also be able to provide them with intelligent forms that they can save and come back to later instead of having just flat forms. One really important thing is you'll be able to provide for e-pay and credit card, which will provide for ease of transactions. And then business intelligence, which you'll see about halfway through, the BI tool is going to be the statistical analysis and the data correlation system that will provide us for that, the good information to provide for better revenue analysis and forecasting, to provide for greater compliance and collections opportunities within the revenue environment. Next slide, please. I find myself going back to this quote that I learned from David Atkins during my time at the Toll Fellowship last summer. He made this quote the last day that I was there, and quite recently I've had to rely on it more and more because ultimately this is an exciting time for states to look at running their business in a different light. For New Hampshire, it has spawned the creation of a commission to study business taxes, to review whether state law is keeping up with ways businesses are doing business, and do the laws really need updating to keep current with the corporate forms? Do the laws continue to do what they're intended to do, which is very important on a going forward basis for any state. For New Hampshire Department of Revenue, it has spawned an entire evolutionary change throughout every single floor of our 69,273 square foot building. We're moving from an entirely manual process-oriented shop into a 21st revenue-generating information-rich team. We'll be providing greater ease of customer service to our constituents, which means for greater revenue and ensuring the state's revenue stream is preserved. We look forward to working with the legislative bodies to provide them the best information through our new statistical package and our business intelligence in order for them to make informed decisions about the direction the state should move in for continued growth. And I believe that wraps up my slide. Thank you very much for listening.
Well, thank you. For those who joined us a little late, that was Assistant Commissioner Missy Fulton from the New Hampshire Department of Revenue, and she was a 2010 Toll Fellow, so we really appreciate that presentation, Missy. Now, at this time, well, I'd like to start out just to clarify something Missy said. Just wondering, Missy, when you talked about the new definition of business activity in New Hampshire, has that been challenged legally by anyone?
It has not, actually.
Okay, interesting. I didn't know whether there would be some type of a suit with regard to any conflict with any federal provisions. But well, we'll wait and see. Is it pretty fresh? You've just had that recently?
2007, so it's about 4 years old.
Interesting. Okay, good. All right. Well, at this time, I was wondering. I'm not seeing any messages. I mean, any questions that have come in from the listeners or participants at this point. At least it's not up on my chat form here. So
I have those questions, but I've just put up a slide with those pre-submitted audience questions. If you can see those.
Oh, yes, I do see that.
And I do have a few that have come in from folks during the webinar as well that we can get to.
Great. All right. Well, we have about looks like about 8 minutes left. And the first question comes from a state or a territorial senator in the Virgin Islands. Specifically, how are U.S. territories increasing revenues? And I think either Michael or Missy had checked that out. Is that correct?
Yes, I had. Actually, it's Carnival week down in the Virgin Islands, so I'm kind of wishing I was there right now looking at drizzly rain and 50-degree weather. In any event, I understand that at least the Virgin Islands has been going through so many of the same problems as many other state governments are going through, with doing lots of budget cuts and beginning the process of laying off employees, which is unfortunate. But I've been told that in order to increase revenues, they have also been looking at increasing taxes in the gross receipts area and the hotel occupancy tax, as well as continuing to provide incentives for businesses to relocate to these areas.
Well, and I guess from both of your perspectives, the territories would have as much leeway as the 50 states do, or the District of Columbia to a certain degree, in generating revenue as they see fit. Would that not be true? Michael?
That's correct.
Yeah, okay.
Mm-hmm.
There's no, as far as we know, there are no particular restrictions on the territories beyond what the states have. So, okay, and then the next one comes from the private sector individual in District of Columbia. How are states finding revenue for transportation costs? Either one of you want to address that?
Well, I know that Vermont, excuse me, excuse me, I was just about to sneeze. Vermont has in 2009, I believe, started the Transportation Infrastructure Bond Fund, which added additional monies onto the diesel and gasoline tax. And in fiscal year 10, I believe it raised about $15 million, and it's considered a very important transportation issue in Vermont. It's really just in, it's a substantial increase in funding over the past few years. However, it's really an extension of things that are done previously, not really anything that is new. It's essentially just future borrowing against transportation and gas tax revenue.
Okay. Missy, did you want to comment on that?
Sure. I'll just briefly touch on a hot topic in New Hampshire of the most recent is a possibility of a temporary lowering of the gas tax for 2 months. There's been a different perspective depending on who you speak to as to whether it will remain revenue neutral or whether it will actually bring more revenue to the state. For a temporary time period, it has not been tested, and I'm really unsure as to whether it's really going to do what it's intended to do.
Okay. Well, and I can speak from Kentucky's perspective. I think it was 2 years ago we essentially made the gasoline tax more elastic by taking off the restrictions as the price of gasoline increases. That has pretty much helped us from really having major problems in our transportation budget. There also is there are 2 major infrastructure projects over the Ohio River. New bridges are needed in Cincinnati to northern Kentucky and from Louisville to southern Indiana. And the state of Kentucky does not have the money to do that, so the commissions overseeing the Louisville project are considering tolls. Indiana will pay for it because they have money left over from selling their turnpike, Indiana Turnpike in northern Indiana, to a private entity. So they have money stashed for their end of the project, but Kentucky does not. It's a real dilemma.
I would say one issue that's, if I may, Representative Wayne, that's very important to all jurisdictions. As New Hampshire talks about potentially lowering its gasoline tax, and at the same time the Vermont State House is debating whether to increase the cigarette tax, state tax competition is a really big issue. And, the Commission spent a lot of time trying to find persuasive data whether this, the effect of tax competition on business tax revenue and income tax revenue and sales tax revenue, and the record is very mixed. But it's definitely a big issue going forward, and we're watching New Hampshire's decision on the gasoline tax just as intently to see what kind of impact it might have on our eastern border and our gas vendors there.
Interesting.
Yeah, and by the same token, we're following the trends of other states as to what's going to happen in the tobacco tax arena. But because of the same possibility, we're looking at actually lowering our tobacco tax. And with the issue of fuel prices being what they are, the large question in people's minds is it going to be enough to drive people cross-border to provide for those sales because of that fuel cost?
Interesting. We have similar issues in Kentucky. We have the highest rates of cancer in the nation, and one of our proposals was to increase the, and we have also one of the lower cigarette taxes or tobacco taxes. So one of the proposals we've made is to dramatically increase the tobacco tax, not so much to generate revenue or to worry about cross-border trade, but to stem the cancer rates in the state. So,
wow. And
then we had a nonprofit member from Louisiana who's asked the question, what's a reasonable formula for taxing the pipeline transmission of oil, gas, LPG, and so forth through a state? Now, I think this was did anyone get to research this ahead of time? Because I think there were questions of interstate commerce there. And I don't know if either of the panelists got to find an answer to that. Were you able to?
No, and unfortunately, after our conversation yesterday, I wasn't able to satisfy myself that I had found an answer regarding whether this would be out of bounds under the Commerce Clause. But that is where the mind immediately goes, and about whether the jurisdiction considering this has terminals, or whether it just be passing through. In Louisiana, obviously, I think there'd be terminals, obviously. But that's a great question, and unfortunately, I was unable to come up with a satisfactory answer.
Well, and we
right,
can
and,
assume,
and I guess looking at, I'm sorry. I guess looking at it from a what is flowing through your state, mindset, we measure many things in different units of measurement, whether it be gasoline or telecommunications transmission or kilowatts. And I guess I almost analogize this to a railroad. We tax the railroads that flow through the state based on the fair market value of their property. So I'm wondering if there's a unit of measurement for the flowage as it flows through that state. That is a very interesting question, though.
Yeah, definitely one that needs further research by all of us. So, well, I see in Kentucky it's now 3 p.m. That's the time that we end our webinar.
Right. Representative Wayne, if you guys have just a few more minutes to stick around, we've got just a couple of audience questions that have come in that I'd like to take a couple of minutes to address if you guys are amenable to that. Are you okay with that?
I'm amenable, yes.
Yes.
Okay,
absolutely.
Then coming from California, we have the question, for states considering taxing new services, what economic data exists from which to estimate revenue?
Okay, in Vermont, this was a big question, because I would say particularly in revenue-neutral tax reform, there was a question of if you expanded the sales tax base, particularly to services, how much could you lower the rate? So we really wanted to get the revenue estimates right. And what the Joint Fiscal Office staff did and the tax department did was to look at federal economic census data and be able to parse out how much was spent on particular services in Vermont and how much of that was attributable to consumers and to businesses, and to develop models from that. So it was really the federal economic census data that we used as a base to develop those types of estimates. And I know the Vermont Legislative Joint Fiscal Office can answer more specific questions if that particular webinar attendee would want to know how they did it.
Okay. Missy, did you have any comment on that one?
Well, one of our largest problems is every time we go to look at the possibility of taxing something new, we don't have any data on it because we don't have a personal income tax. So quite often we have to rely on drilling down from federal statistical data and just trying to match up some of the blocks within that so that we can make a determination as to what may be the subset of people for purposes of revenue generation. It is very challenging for New Hampshire to do that statistical analysis, though.
Yeah, and we found that in our tax reform proposal, we proposed an expansion of the sales tax to services that are primarily used by the wealthiest people in the state, and the estimates are, I'm sure, not refined. They're more guesstimates than estimates, but a lot of that will just be proven once you, I guess, once you impose the tax, see what comes.
Right.
Okay.
Krista, was there another question?
Yes, we have another question from New York. Many states are turning to eliminating the EITC or to taxing 501c3s in order to balance budgets and generate revenue. What are the alternatives to present to state leaders that would protect the low to moderate income wage earners?
Well, this is something that in Kentucky, under our tax reform proposal, we are proposing the beginning of an EITC, an earned income tax credit, at 15% of the federal rate. This is to offset our unfair tax system we have currently. The state and local taxes combined show that the bottom 20% of the folks in the state, in terms of income earners, are paying nearly 10% and some 11% of their income in state and local taxes, whereas the wealthiest folks, those in the top 5%, some of them are paying 6%. So in order to offset this, to make it a more progressive system, a more just system, we have proposed for those bottom 20% the earned income tax credit. So we're thinking in our reform just the opposite. A lot of folks, I think because of maybe the Tea Party movement and other more libertarian approaches are saying that we need to prove that the EITC works. But we all know politically this was initiated by President Reagan, and consistently in the last 30 years or so, it's been termed the best poverty-fighting proposal or measure that we can institute. So there's a great deal of merit in having an EITC. Before anyone throws it overboard, I think they really need to look at the long history of this and how it improves the lives of the very poorest and those the most vulnerable.
I would say Vermont's Blue Ribbon Tax Structure Commission went in the opposite direction. There was never any suggestion of getting rid of the EITC, and I think when questions about it came up in the legislature this year, legislators on both sides of the aisle were supportive of the EITC as an anti-poverty program. However, to try to give you one potential alley to go down, the Commission recommended eliminating all standard and itemized deductions and instead replacing it with a means-tested credit. And so the idea was that at a certain level of income, you benefit more from lower tax rates than any sort of standardized or itemized deductions.
Yeah.
And that really allowed the Commission to create a credit that was more robust and could really help lower income folks because it was means tested.
That's a very good point, Michael. And with our proposal, we've also eliminated deductions for similar reasons. Missy, did you want to comment on that at all?
Well, New Hampshire, I think, has one of the best EITC opportunities available since we don't have a personal income tax. And when Michael makes comments about concern of flight to New Hampshire by Vermonters, we would love to have them, Michael. Thank you.
I live about 500 yards over the border in Vermont, so I can see New Hampshire from my front door. But you know, one thing that's interesting, and I think this to be true when you're thinking about revenue generation and things states can do. I know, much like many other jurisdictions, you know, Vermont designs its programs, and I do know New Hampshire is particularly good at this, but designing programs to maximize federal dollars. And that's, you know, whether it be the EITC or your hospital provider taxes, you know, that's something to consider as a way that you can convince folks that drawing down dollars is a worthwhile investment.
Absolutely.
Yeah.
Okay. I have another question from Kentucky. How much interest is there in making state tax systems more progressive, and from both the voters and the legislators? You've talked about this a little bit in the previous answer, but if you want to just touch on it again real quickly.
Well, from my perspective, this is one of the main difficulties that state tax systems have, is that they are not progressive. Originally, Kentucky's income tax system was very progressive, and when I speak to groups about this, I explained that when I was growing up, my father cut all of our hair by putting a plank over the washing machine, setting us up there and buzzing us. We mowed all the lawn ourselves. My mother did home perms instead of going to the beauty parlor. And today, what you have is, you know, a lot of expansion of services, including hairdressers and barbers and lawn care services and tailoring services and so on and so forth. So I think when you talk about fairness in the system, making it more progressive, if you're going to expand into the service area, I think it's very important that you recognize that a sales tax is one of the most regressive taxes you can have, and that the way to offset that is twofold. One is to, if you're going to expand only into areas that are primarily used by the wealthy, and secondly, to make sure you have a really good EITC. That helps make the system more progressive and also expands the revenue, by the way.
You know, I would say that in the Commission's discussions, Representative Wayne is exactly right. That the Commission, you know, felt much more comfortable with expanding the sales tax to services, knowing that it was going to bolster a credit targeted to lower income Vermonters and working class Vermonters. And certainly side discussions during the legislative session were about increasing that credit to offset the regressiveness of the sales tax. I mean, I think it's interesting to point out that it's an article of faith in Vermont that our tax system is highly progressive, and that's certainly true for the income tax system. But as the earlier slide suggested, all that personal income tax serves to do is to make the system about even, because the sales tax is so highly regressive and the property tax is a little bit less so. So if you have a flat tax or an income tax at the state level that's not highly progressive or not progressive at all, you know, you're going to have a regressive tax system, and it's a policy choice that you know, that people are going to either accept or determined to do something about. But it's interesting in Vermont because we're considered highly progressive, but all that income tax serves to do is to offset the regressiveness of the other taxes and makes it about even.
In the tax credit arena for businesses, the New England Public Policy Center put out an interesting analysis about a year ago as to whether the progressive thought process behind those types of tax credits really were fruitful for the states or really were a revenue loss. And it's a very interesting analysis because they came up with the opinion that they really didn't provide for the opportunities that the state was going to thought it was going to get out of that progression.
Mm-hmm. Okay. Did you have another one, Kosta?
I do. I have a question from Georgia. What specific strategies would you suggest to policymakers as they consider enacting legislative changes to respond to structural changes currently sweeping the state, when the concept of suggesting a tax increase is considered anathema?
Well, in Kentucky, we hear the refrain, "I'm not going to raise, we're not going to broad-based tax increases during a recession." I think the strong Tea Party movement in our state, we've just elected Rand Paul to the U.S. Senate as a Tea Party candidate, makes it real important for us to look at our revenue system as one that if we're going to reform it, we have to make sure that it's fair. Now, whenever you have a reform of any tax system, there are going to be tax adjustments. So you are going to increase some taxes, primarily for groups that are not being taxed fairly now, not paying their fair share, and you want to decrease taxes to make sure that people who are overburdened by the tax structure will have some of that lifted. So I have real problems with the no new tax pledge and anyone who says you're never supposed to raise any taxes, because that paralyzes any reform when those statements are made or when those people come forth and believe that their agenda has to be maintained.
I would refer the person asking the question to my first slide, which is the 10 Principles of Sound Tax Policy. One of the #1 questions to ask is, as a matter of fairness, are the people that should be paying, are they actually paying? There may not be a need to increase taxes if you broaden the base appropriately.
Very, very good point.
I would agree entirely with Missy. I think she raised a great point. I know the Commission spent a lot of time with principles up front, and they mirrored entirely the slide that was up there. I think the legislature here is really working on two fronts, as the governor has said that he would veto any, well, not that he would veto, he said he's against any broad-based tax increases. The legislature has really looked at tax expenditures and other base broadening opportunities, whether it's shifting the income tax base or looking at stuff like that, because, you know, broad-based tax increases are unpalatable here, but there are certain things that you can do to make your base whole. The other path that the legislature has gone down is that the past few years in the budget, they have specifically added compliance employees to the tax department. Also, they've okayed a data warehouse to better leverage information so we can get folks that aren't paying their fair share and try to reduce the tax gap, because that's a way in which you can raise revenue and make sure everyone's paying their fair share without raising tax rates.
Okay, I have one final question, and Michael might be the one best situated to answer this, but the question is again from Georgia, and it makes note that several states have formed commissions and blue ribbon panels to explore the tax systems, and that not all of the time these recommendations are taken into account immediately, kind of get shoved to the back burner. So they are looking for any suggestions that you guys have as to how direct actions by state policymakers, what they can do to adopt these recommendations and, you know, keep them in the forefront and get them adopted before they might die off after the next issues. If you guys have any suggestions on that arena.
All I can say from the Vermont experience is that the Commission was very well received. It was well respected. People still use, people are definitely referring back to the document and the recommendations, and I think it served a purpose in that way. But of course, like most blue ribbon commissions or tax reform commissions, the recommendations haven't been adopted. I think that's something that folks wanted here but didn't get was the Commission's report came out and folks went to the legislature and made their case, but then there wasn't a lot of public outreach afterwards, and because of that there really wasn't a lot of momentum built for it. And so I think when you're putting together a tax reform commission, if you have policymakers that really are committed to it, they should really think about what happens the day after the recommendations come out. And I would give a lot of credit to the leadership of the legislature here and the chair of the relevant committees because they have spent a lot of time going through these. But you need to really reform the tax code. You need to create a dialogue and relationship with stakeholders and have folks buy in across the spectrum. So in designing one of these or pulling going to work on one of these, folks should really think about what they want to accomplish and what they're going to do after the report is and the recommendations are released.
That's an excellent point, and I would just add that in Kentucky, if there's going to be any reform here, it really would have to be initiated by the governor who has the bully pulpit and who can bring the different constituencies together, including the legislative leaders. But it has to be in Kentucky one central leader, and that has to be the governor.
From an information standpoint, agencies really don't take an opposition or a confirmation when they're looking at pieces of legislation. The biggest thing is information, is being able to have a source of information that's reliable and that's accurate. Without that information, you can't have the conversation or try and offer up opportunities and initiatives to legislators so that they can make those, so that they can put those ideas and recommendations in place. Without the data to stand behind it, it just ends up being a good idea.
Excellent point.
Yeah, we could not have done the work that we did without the cooperation of the Vermont Department of Taxes, particularly the IRS data that they have access to. So getting buy-in from agency staff, which obviously can't, generally is not out there advocating for a position, but has all the expertise, is really vital.
Right, and it needs to be a partnership effort.